Harmony in portfolios, integrating environmental factors into investment strategy. Introduction. In an era where environmental consciousness has permeated global discourse, investors are increasingly recognizing the significance of aligning their investment strategies with sustainable and eco-friendly practices. The integration of environmental factors into investment decisions has evolved from a mere ethical consideration to a strategic imperative. Understanding how investors can navigate this landscape involves delving into the multifaceted realm of environmental, social, and governance (ESG) criteria, and embracing a holistic approach to building resilient, environmentally conscious portfolios. ESG framework unveiled. The ESG framework serves as a compass for investors seeking to incorporate environmental considerations into their decision-making processes. Environmental factors within ESG encompass a spectrum of issues, ranging from a company's carbon footprint and resource efficiency to its impact on biodiversity and adherence to environmental regulations. By evaluating companies based on these criteria, investors can identify opportunities that align with sustainable practices while mitigating exposure to businesses with adverse environmental impacts. Carbon footprint and climate risks. One of the key environmental factors investors consider is a company's carbon footprint, the total greenhouse gas emissions directly and indirectly associated with its operations. As concerns about climate change escalate, investors are scrutinizing corporate strategies for mitigating climate risks. Companies that proactively address their carbon emissions, implement energy-efficient practices, and invest in renewable energy sources often stand out as attractive investment opportunities. Investors can leverage tools such as carbon intensity metrics to assess a company's environmental impact relative to its industry peers. Water management and resource efficiency. Water scarcity and resource management have emerged as critical environmental considerations within the ESG framework. Investors are keenly evaluating how companies utilize and conserve water resources in their operations. Businesses that demonstrate efficient water management practices reduce waste generation and implement circular economy principles are increasingly gaining favor among environmentally conscious investors. Incorporating such factors into investment decisions not only aligns with sustainable practices but also positions investors to navigate potential regulatory changes related to resource usage. Biodiversity and conservation efforts. Preserving biodiversity and promoting conservation efforts are integral components of responsible investing. Companies that actively engage in biodiversity protection, avoid harmful practices such as deforestation, and support conservation initiatives contribute positively to environmental sustainability. Investors can evaluate a company's commitment to biodiversity by examining its supply chain practices, land use policies, and engagement in conservation partnerships. Aligning investments with companies committed to biodiversity conservation not only fosters ethical investing but also mitigates long-term environmental risks. Renewable energy and clean technologies. Investing in companies at the forefront of renewable energy and clean technologies is a direct way for investors to contribute to environmental sustainability. The global shift toward cleaner energy sources has created opportunities in sectors such as solar, wind, and electric vehicles. Investors can identify companies that prioritize sustainability in their energy portfolios, actively reduce dependence on fossil fuels, and innovate in clean technology. These investments not only align with environmental goals but also position portfolios to benefit from the transition to a low-carbon economy. Regulatory compliance and environmental standards. Environmental regulations play a pivotal role in shaping the landscape for investors. Companies that proactively adhere to environmental standards and regulations are often better positioned to navigate regulatory changes and market shifts. Investors can assess a company's environmental governance by evaluating its track record of compliance, engagement with regulatory bodies, and commitment to exceeding minimum environmental standards. Investments in companies with robust environmental governance structures contribute to the creation of resilient portfolios capable of weathering regulatory uncertainties. Impact investing and sustainable funds. For investors seeking a more direct and targeted approach to environmental considerations, impact investing and sustainable funds provide avenues for aligning financial goals with environmental impact. Impact investing involves allocating capital to projects or companies with the explicit goal of generating positive environmental and social outcomes. Sustainable funds, on the other hand, pool investments in companies that adhere to ESG principles, allowing investors to participate in a diversified portfolio with a focus on environmental sustainability. These investment vehicles empower investors to contribute to positive environmental change while realizing financial returns. Measuring environmental impact. Quantifying the environmental impact of investments requires robust metrics and measurement tools. Investors can leverage environmental performance indicators, such as carbon footprint metrics, water usage ratios, and biodiversity impact assessments, to gauge the sustainability of their portfolios. Additionally, emerging industry standards, such as the Task Force on Climate-Related Financial Disclosures (TCFD) recommendations, provide a framework for companies to disclose their climate-related risks and opportunities, aiding investors in making informed decisions aligned with environmental goals. Conclusion. As the world grapples with environmental challenges, investors wield a unique power to influence positive change through their investment decisions. Integrating environmental factors into investment strategies is not merely an ethical choice. It is a strategic imperative that recognizes the interconnectedness of financial success and environmental sustainability. By embracing the ESG framework, evaluating companies based on their environmental impact, and leveraging impact investing and sustainable funds, investors can contribute to a more sustainable future while building resilient portfolios capable of withstanding the evolving dynamics of the global economy. In the symphony of investment decisions, harmonizing financial goals with environmental considerations is not only prudent, but essential for fostering a world where profitability coexists with planet-friendly practices.